Hi, I'm Jeremy Cook. I'm the Chief Economist here at World First. Hopefully, as you well know, World First are an international payments company who help e-commerce providers across the world repatriate profits from selling on marketplaces around the world. If you have an e-commerce operation in one country and are selling elsewhere and you need to bring your profits home, we are the people who can help you do that. 2016 has been a pretty volatile year. In February, a pretty volatile month in currency markets. We saw commodities rise over the course of the past couple of weeks. Oil up by 12% in 1 day's trading. The Japanese yen strengthened by 6% even after the Bank of Japan cut interest rates into negative territory. And the referendum fears here in the UK are starting to really hit business sentiment, and the pound has fallen to 7-year lows against the US dollar. Now, what does this mean if you're an e-commerce operation, if you are selling goods abroad? Well, simply put, the volatility isn't great news for you, and especially if we're seeing a very, very strong US dollar, as we have seen for the past 12 to 14 months or so. If you're selling goods in Europe, for example, and the euro continues to weaken, as many economists are predicting it's likely to do throughout the course of 2016, then for every product you sell in Italy or in France or in Spain, you are getting less dollars back into your operations in the United States. Forward contracts and hedging structures, the kind of products that World First are able to offer e-commerce sellers, allow you to protect your profits in one phrase. It allows you to be able to sit there and guarantee that you know exactly how much money you are bringing back. Now, as far as currencies go, the US dollar continues to strengthen. The Federal Reserve, the central bank of the United States, are still talking about interest rate rises, having hiked interest rates in December. Unemployment continues to fall, wages are starting to rise, the services and manufacturing sectors are continuing to grow. And for a Federal Reserve which was scared at the end of last year about the impact of an interest rate rise on market volatility, they have a very, very interesting decision coming up at their March interest rate meeting. Do they go with the data, or do they go with the fears and hold policy? Likewise with the European Central Bank, the Federal Reserve of Europe, they are unable to get away from low growth, high unemployment and low inflation. We believe they're going to continue to weaken the euro over the course of 2016, but the euro has recently been strong as traders and investors have looked for a safe haven away from recent market volatility. Sterling, as I said, has been very volatile as a result of our uncertainty over the EU referendum, which was announced and will take place on June the 23rd. Now, we think there's a significant downside premium built into sterling at the moment, and that if the UK remains part of the EU, which the opinion polls are showing at the moment, that sterling could easily retrace 7, 8, 9% over the course of the next couple of months. Fingers crossed the UK stays in the EU, otherwise sterling dollar could fall as low as 120, we're predicting. Elsewhere, the Aussie dollars continue to remain volatile as a result of the fears over the Chinese economy and falling commodity prices. Recent good news from the domestic economy have pushed Aussie dollar back above 71, 72, but we are looking for downside later on in the year.